Hi guys, welcome to today's lesson. And today's lesson is just going to be a continuation of what we did in the prior lessons, right? Remember, we are carrying on from where we left off, okay? Without any further waste of time, let me just get into today's content. So I want to highlight to you guys that today we're going to focus on the steps that we need to take when we record a transaction. Simply, that's the topic over there. Steps to recording a transaction. So remember, there's like a accounting trail, right? So we need to follow that. We need to make sure that transactions are recorded correctly. Therefore, that will give us um, accurate financial reports that we can use to budget or perform other financial stuff. Okay, and then here we have few points that they have pointed to us. They say refer to the rules of accounting and classification of accounts on page 2, of which you already did that. The rules of accounting, which is the total asset being equal to the total liabilities added together with the owner's equity, right? And then the classification accounts is those accounts that we did in the prior week, where I was showing you which accounts belong to which family. We have assets family, which has two sections, which is divided into two sections, the other one being the non-current assets and the other one being the current assets, right? And we've highlighted the difference between the current and the non-current, okay? And we also have another family being the liabilities, which also has the same as the assets, which has the current and non-current liabilities. And we also have the owner's equities, which are decreased by the expenses and increased by the incomes, okay, apart from the capital and the drawings, okay. And then here, the first point here, they said, read the transaction or the adjustment. So the main purpose of you to record, remember, you are trying to give a business state or the business status at a certain level or at a certain stage, okay? So the first thing that you need to do is to make sure that the transaction that they have highlighted to you is understandable. That way, it's gonna be easier for you to reflect that on a paper, right? So you need to make sure that each and every transaction, before recording each and every transaction, try to think about it. Try to think if you were part of the company, how does that sound? Is it okay thing that happened? How is my bank account being affected? What is affected? Like, ask yourself how, why, you know, how, why, and what questions, right? Try to understand. So because if you just record, if you think you just see a transaction, you think, oh, okay, it's this transaction, I'm just gonna take my luck. This might be an asset might be affected, equities may be affected, you're not gonna get anywhere. So you need to make sure that you understand the transaction. Also, again, you have to make sure that you know which accounts belong to which groups. Is it an asset? Is it an equity? Is it a liability, right? And therefore, after, you're gonna check, is it current, not current, or drawings, and so forth and so forth, okay. And then we have under one there, they say bought stationery and paid by check for 150 rands, okay. So you are buying what? You are buying a trading, no, inventory. All right, let me just try to zoom it in. Yeah, that's much better. So they say read the transaction. Da, 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 da. So the transaction that we have here is bought stationery and paid by check for 150 rands. You are buying stationery. Who are you? just a random person, just a random business that does not sell stationery. So that means you're buying stationery to use it. You're buying it for end using purposes. That means it's an expense because you're using to consume. I mean, you're acquiring to consume. You are taking or you're buying it in order for you to use it, right? So that means that is an expense, okay? And that expense is what is paid by a check, okay? A check, we all know a check is from the bank, right? So that means a check decreases. You are paying, you are decreasing the amount that you have in the bank, because now you are paying 150 to the person that's gonna give you stock. So what I mean, sorry, that's gonna give you stationery. So stationery is gonna be coming in what, and then in trading of money. So the money is being given away and the stationery is being received. So that means what, there's a transaction there. See, we have transacted. So the two accounts that are going to be involved here is stationery and bank, because you're getting stationery is an expense, and we have an account that we call a stationery, right? Hence I just say stationery and bank, because we don't have a check account, but we have a bank account where the checks and everything goes into that accounting account, right? And they say identify the two accounts affected by this. So this here, I'm just gonna try to highlight this. I'm not sure if it's gonna allow me to change a color at this stage. Okay, so it say double entry principle. So in each and every transaction, there's gonna be at least there's gonna be at least two transactions that are involved, okay? At least, right? I'm not saying that they can never be 3 or 4, 5, 6, or whatever amount of accounts that are involved in one transaction, right? Because sometimes, let's say for example, I'm just gonna give you an example. So you see here we have two accounts that are involved because we are buying the stationery by check. Ne? Imagine that if we didn't have enough cash to buy the stationery, we went to a store and we want stationery for 150 rands, but we only have 100 rands. Can we pay 100 rands cash, and then 50 rands we're just gonna pay it next month? That is a debt, right? So that means it's a liability now. So that means we have what? We have gained a stationery, and then we need to pay 100 rands. I mean, we need to pay 150, but we have already paid the 100 rands. So that means this transaction is going to be divided into 3. So that means it's going to be 150 for stationery we received, and then we're going to have 100 rands that is for bank. It decreased the bank, and then again we're going to have what? We're going to have the liabilities, which is the debtors control. So the debtors control is going to be the balance, which is 50 rands. So that means we have what? We have 3 accounts involved here, being stationery, bank, and the debtors control. So for each and every transaction, you have to think through about it. Think it through, right? You need to make sure that it makes sense, okay? So you see, you need to have at least at least two transactions that are two accounts that are involved in one transaction. Remember, for each and every credit, there must be a relevant credit. For each and every credit, there must be a debit. For each and every debit, there must be a credit. So a debit and a credit must always balance. If they don't balance, that means you did something wrong, and you need to probably recheck it and ensure that you've recorded everything as it was supposed to be recorded. Okay, and then we're going to go to number 3 here. They say decide what types of accounts are these. We're going to need to classify. Already we have classified stationery as an expense, because what? We are using it, we are buying it to use it, not buying it to sell it. If we were buying it to sell it, that was gonna be inventory, right? And inventory is an asset, right? And a current asset. So this is not the case, right? Remember, the certain types of entities applies different, or they work differently. So you need to make sure that you understand the industry that you're working with, right? So in this case, we're just working on assumption that it's a normal business that does not sell stationery. Therefore, stationery will be regarded as an expense because they are buying stationery probably to use it, to record transaction, to give clients, or to make notes of some sort, anything that needs to do with stationery, or anything that one can do with stationery. So they are buying stationery to use it. That is an expense, all right? For business to use, that is an expense which decreases the owner's equity, as I've highlighted, right? And then again, we have a bank. That is a what? That is an asset. Okay, bank is always an asset unless stated otherwise. Unless if they're saying that the bank has unfavorable bank balance. If the bank has unfavorable bank balance, that means that you are running at an overdraft. Overdraft means that you have withdrawn more than you have. So if you withdraw more than you have, that means what? That means you are owing bank, okay? So when you owe bank, it's a liability. But when you have a positive bank balance, which is in this case, because they didn't say anything about the bank being unfavorable, that means what? That means the bank now owes you, right? The bank owes you. The money is coming out of the bank. Hence, we classify the bank as an asset in this case. So I say that a bank can be an asset or a liability. It's only a liability if we have unfavorable or a negative bank balance, and it's an asset unless stated otherwise. If they didn't say anything about the bank being unfavorable or having a negative bank balance, that means what? That means the bank account is an asset, okay? And then how are we going to treat a bank that is negative when we receive money? So when you receive money, meaning when somebody pays for something, or when somebody buys something from you, the positive that will be getting into the bank will be decreasing the loan that you have, or the loan that you owe the bank. Okay, hope that makes sense. So each and every money that you receive is not going to be necessarily increasing your bank balance. It will definitely be decreasing the amount that you owe the bank, okay? Whereas when a bank account is an asset, that means each and every money that enters the business increase the balance. Each and every time the money enters the bank account, the balance goes up. Alright? Perfect. And then now let's look at 4. 4 says, decide which account is debited and which account is credited. Which account is debited and which account is credited. This takes us to the very first lesson, if not the second lesson that we had, where we were classifying, or rather going through the rules of accounting. Which account debit, which account credit, which account increases on the left, which account decreases on the left. And in this case, we have identified that the bank is an asset. We have identified that the expense is the stationery is an expense, which makes now the things easier because the money is decreasing the bank balance because we are paying for something. So I'm just gonna have my bank account here. I'm gonna have my bank account because I said, remember, assets increases on the debit and decreases on the credit. So because I am paying, the money that I had in the side is going this side. It's decreasing because I'm paying. I'm taking out money. So that means the 150 is gonna go here, and I'm gonna have a stationary here. This 150 that's going out, it's going because of the stationary. And correspondingly, I'm gonna have a stationary account, stationary, and then I'm gonna have what? Because this side is credited, that means automatically this one is gonna be debited. So for each and every debit, there must be credit. So I'm just gonna say bank here. So this is how it works. So for each and every debit, there must be credit. But nonetheless, other than doing it like this, you can just say that you know that expenses are always debited. Remember, we only credit them if only we are correcting an error, right? Only when we are reconciling something, that's when we're gonna record this side, not when we having an absolutely new transaction, right? Perfect. And that's it. And then let's see, record your answer showing an effect on that. Okay, so already we have highlighted our account to be debited, which is this one. So the account debited stationary with this one, and then the account credited is bank, because the bank is decreasing. All right, so we're gonna have a bank here as shown there, and then we have our little accounting equation here. We said expenses decreases owner's equity. That is why you are seeing a minus 150 over there. And then we also said that a bank is an asset, and it's also decreasing because we are paying. Hence we have 150 being negative under the asset. And this is actually a formula. Asset is equal to owner's equity plus the liabilities, right? So when you add owner's equity and liability, when you add these two, negative 150 plus 0 is going to be negative 150, and then assets total is negative 150. So negative 150 is equal to negative 150. That means this formula or the equation is correct, right? Because the asset is equal to the owner's equity plus liability. There's a balance, right? So the moment you find yourself having a 130 or having a 30, having something different, like the assets are not balancing together with the owner's equity and liability, that means you probably did something, or definitely did something wrong, because it's supposed to balance. Okay, so your total asset has to always be equal to the owner's equity and the liabilities. And there they're making a note, a 0 indicates no effect, do not leave blank. So it's important to show this 0 over here, because it shows that the transaction does not affect the liabilities. Okay, so if you leave a blank, you're not gonna get a mark, ne? You're gonna probably not get 100% of the marks. You're probably gonna get 70% of the marks, because you left that out. So you need to show for each and every transaction where the certain section is not affected by the transaction, you put a 0 to show that no effect whatsoever. Okay, and thank you guys for today's lesson. I'll see you guys in the next one. Enjoy. Bye.